All right, everybody, I'd like to introduce our next presenter here at the Planet MicroCap Showcase Vancouver. It is Kathy Casey, CEO of Simply Better Brands. Kathy, the floor is yours.
Thank you. Thank you, Robert or Bobby. I guess it depends upon who you talk to around here, right? Okay, great. First and foremost, I think we've got about 50 people online, so I know it's a small group here in the audience, but for those of you that are here, thank you so much for attending. As Robert had mentioned, my name is Kathy Casey. I'm the CEO of Simply Better Brands. I'm going to stay close to the podium today because they're having a little trouble with the clicker, so I'll make sure that I do that. I think where we'd start with first is, and I see Paul, I was in your session this morning, I'll reference Paul a little bit here. You know, when you think about Simply Better Brands, I think some of the criteria that you had were, is the price below the value? We certainly think so. Do we have low insiders? Yes. Do we have rapid growth above 25%? Yes. Is it a stock that's not highly promoted? Yes. So we'll go through some of the criteria here today, and you can certainly give us some feedback and respect on the stock. I'm really open to very informal, so feel free to stop me, pause me, ask any questions as we go through. I think it's always a bit more fun if it's a conversation. So let me start a little bit with what I wanted to take you through today. Simply Better Brands is not a mining company, right? Not a mining company. So we'll fix that up a little bit here in Canada. We are actually a consumer products good company. And we are a consumer products good company that clearly defines itself in the wellness space. Post-COVID was a catalyst to people being very, very interested in what goes in, on, around their body from a wellness perspective. And our company has been able to capitalize upon that. So you'll see there's some very specific criteria of the products that we either buy or build or bring to market. And today we're going to spend a little bit of time on these three topics. Overview of the company. The second one, of course, giving you a perspective about, where we play, and then ultimately, how the company specifically wins. A quick summary here. I think it'd be good to give you if you hear no other slide today, right? No other slide today. This is a good one. We took the company public back in December of 20. We're traded on the Toronto Stock Exchange Venture Board. The company was running about a year before that. So we're about a 4-year-old company. We, during that time, either pre-going public or after public, we've actually bought 5 companies. So we've had a very aggressive merger and acquisition appetite because we want to put together the right portfolio that we thought could help these consumers specifically on their wellness journey. So, so where are we today, right? We've grown the company 4x since in the last 2 years. We are a purpose-driven company. We believe that people should have access to wellness, and so many people don't. And so we try to change lives through wellness, and we do it very authentically and transparently every single day. We're in huge categories. So you'll see a little bit, we're in skincare, we're in food, we're in pet, we're in nutritional supplements. So we play in a bunch of different categories, all of them multi-billion-dollar categories, and all of them growth categories. So the potential is quite significant. We're made up of a very experienced group of consumer products good executives, and I'll take you through that team a little bit later. They really have spent their entire careers building brands, and we harnessed that knowledge capital as we put the company together. We did make adjusted EBITDA positive in 2022. We will make that as well here in 2023. And we operate with positive operating cash flow, which I know is very unusual or can be unusual in companies that are relatively young like this. But we have a great CFO, a very financially minded CEO, and we're incredibly intent about where we invest our money and how we get the highest return on that money and are able to manage that throughout our cash. We also, while we're trying to be financially stewards of the cash, we do have debt, like some companies do, and we work very aggressively to buy that debt down. So you'll see year to date, we've bought down about $2.7 million of debt. We will buy down at least another $1.5 million of debt here later this year via a payment that's due on one of our loans, but moving certainly in the right direction. How many people here had heard of Simply Better Brands before the MicroCap session? 2 of us, 3 of us. Okay, good, better than I thought. Welcome to your feedback, and thank you so much for interested in following, checking out our stock. It's quite unusual. A stock would do about 80 million US or 100-ish Canadian and actually have very, very little awareness of the stock. So what I would say to you is that we are a very real company with a real portfolio, a strong team, and significant revenues. You may have seen some of our brands here. We have brands here, and if you actually want to walk down the street, you could see TruBar today that lives in Shoppers Drug Mart, Metro, Bulk Barn, Longies, Sobeys, Loblaws, right? So actually even decent distribution of some of our brands, not only in the United States, but also in Canada. What is our mandate? As I mentioned earlier, we're on the mission to authenticate wellness to consumers transparently and ethically every single day. We participate in the plant-based holistic wellness area. And think of really when you're eating foods or using products, mindful of things that go on in and around your body. So really the positives are present, but the absences are negatives on our products. It's clean ingredient and it targets one specific cohort we will call Zillennials. Some of us might have a few Zillennials in the room. So Zillennials is the largest generation of consumers here in the US today. And Zillennials essentially are young millennials and old Gen Zs. So kind of merge between those two. A very wellness conscious group as it relates to their product selection. And often they have a very active lifestyle. A couple mandates for us are high growth. As we said, 300% growth last year. And then separately from that, without question, really being concentric around the consumer and innovation. So as consumer products good folks, one of the things we do is we really try to understand and follow that consumer, see what problems they're having in this particular space, and then launch products and bring those to markets that address those specific needs. A very, very asset-light model. We do use co-manufacturers so that we can move and follow the consumer agnostic of where they go and what form factor that they might want their products or foods in specifically. We operate in 3 growth verticals. One is plant-based wellness. The second one is clean ingredient food. And the third one is around next generation skincare. The first plant-based wellness brand, we have really 3 big brands. One is PKANF, one is TruBar, and then one is No BS Skincare. We've got some other brands that are emerging and nascent as well, but these are really the 3 that make up the biggest sales for the company and the biggest opportunity. PKANF is about half the business. That we originally started as a CBD brand, but we've taken it and we've moved it beyond CBD to actually a nutritional supplements brand. So you'll see things like lemon balm, ashwagandha, apple cider vinegar, melatonin, areas that address consumer need states around things like calm, focal acuity, sleep, pain, where we try to engage with consumers in a way that allow their days and potentially their nights to be better. The second brand is TruBar. It's what I would consider to be the near-term highest potential brand that we have in our portfolio. It's a protein bar, has 12 grams of protein, about 190 calories. Has anybody seen it here in Canada at any of those retailers I mentioned before? Have you guys tried the bar? Okay, well, a little bit of the homework. Now you have to all leave here today and run by a couple of those retailers I mentioned and try one out. Essentially what's magical about this bar is that not only is it healthy, but it also happens to taste good. And a guardrail for consumers, of course, is bar consumers eat bars almost every day and it has to taste good. And this one is non-GMO, vegan, gluten-free, dairy-free, and no added sugar alcohols. So not only is it got these incredible guardrails around clean product, but also in addition, it actually tastes pretty fantastic. And there'd be flavors like cookie dough, salty, all malicious love, right? Some really great nomenclature, some incredible packaging, and very, very good flavors broadly. The last one is in the next generation skincare vertical. We have a brand called No BS, operates with a lot of transparency. You could say No BS could be no bad stuff, or No BS could be, but maybe all popped into your mind originally when you heard No BS. But it's really about No BS on marketing, right? So not only how we position the brand, but then also we banned 1,600 ingredients. So what's happening in the skincare category is that the big players in the category have not cleaned up their formulas. And these next generation of consumers want very clean products to put on their face or around their bodies. And we've done that with no BS. To give you an idea, the category of skincare is growing about 7%, but clean ingredient skincare is growing at 20 or roughly 3x. And we participate in that clean ingredient skincare area. Consumers are leaving these big brands and going to these emerging brands. And what you're seeing across the US specifically is a lot of these retailers now are changing their planograms to add these emerging clean ingredient consumers because they've left the category, are now buying those brands online. And so the way to think about the model is just really simple. We buy brands or we start brands from scratch. We build those brands in an omni-channel environment. And then if and when it makes sense, we sell those brands. And then we take the money from selling that brand and then we put it back into buying another brand or building another brand. So think of it as rinse and repeat, right? So a consumer products company that is actually a brand incubator of wellness products. We're led by a very experienced team, as I referenced. To build brands, it's helpful to have some extensive experience in this particular space. We're fortunate enough to have a very strong team and then also a strong board. Ironically, back in the corner, Richard Kellum, you guys may know, the CEO of DCM and former global executive of Mars, is on our board. Strong, extensive experience with brand building in multiple categories. Mike Galero on the team, big background in M&A, capital markets. Kingsley Ward, well known in the Toronto business community here, is the managing partner of VRG Capital and then also the chairman of Claris Securities. Brian Meadows, you'll see him probably this evening. He's our CFO, big capital markets as well as startup experience. Paul Norman is the chairman of our board. He spent 30 years at Kellogg and ran a $9 billion business there across the U.S. And actually, he ran the U.S. market. He ran Canada, actually. He lived here in Toronto for a while. And then eventually ran all of North America. And for a period of time, actually ran the world for Kellogg outside of the U.S. Myself there, all the way to your left. My background is similar. I have 10 years at Procter & Gamble, startup in between, and then about 20 years at Kellogg, and spent a lot of time working on some of the categories that we're talking about here around wellness foods, bars, about 22 years in the bar category. So when I left there, I ran a $2 billion business. And you could say, geez, Kat, like $2 billion business to a $100 million Canadian company, what are you doing? And I would say to you that I absolutely love it. And spending many, many years in corporate America, business is a hobby of mine. I think it's fun. I think it's really fun to solve consumer problems. And we have a team that every day gets out of bed and say, what's a problem a consumer has? How do we understand what the consumer is looking for? And how do we develop the widget that cause us an opportunity to be able to solve said consumer problem? And that therein lies the portfolio that we own today. So extremely, think of really the team. I like to say that, brand building's in their DNA. So it's we're very, very fortunate to have this team together, and it is part of the secret sauce of the company. How are we doing so far as it relates to revenues? We'd certainly love to see this particular slide here. As you can see, we did about 15 and change, a little over 15 million. These numbers are USD. We did 15 million in 2021. We did 65 million and change there, as you can see, in 22. Primarily driven by incremental consumers on our PureKana brand, and then also brick and mortar expansion with our TrueBar product. And we're slated here in 2023 to do 80 million US. We feel that we've got good line of sight to that. As you can see, halfway through the year, we're at about 48 million. So roughly about 60% so far of our guidance. So feel good about the growth. And again, think of it's buying nascent and emerging brands that primarily are direct-to-consumer brands, and then growing them both in terms of category and in terms of channel. So I'll give you an example. No BS Skincare started as a skincare company, and then we are now going into personal care and launching natural deodorant. True Bar started as a protein bar company, and now we'll be expanding and taking that category over ultimately into protein powders. Where can the brand reach? Where can it stretch? Where will the consumer follow it, right, as it relates to particular categories? We absolutely believe, as I see here on the 80 million, we absolutely believe that True Bar has the potential to be a $300 or $400 million snack bar. Very common in the U.S. that bars can get that big. And we think actually the opportunity for No BS is even more significant than that. So if you said as a shareholder, as an investor, as an assessor of the opportunity, Kath, how do you feel about the future? How do you feel about where you're going? It's a really, really significant opportunity just to be able to say, how do we further penetrate, build the direct-to-consumer business with our own websites and with Amazon? We run our own marketplace of all of our portfolio. And then how do we expand them by channel and ultimately by geography? We do a little bit of business here in Canada, but for the most part, we haven't really, just from a resource perspective, haven't moved around the globe yet. We think actually the U.S. market and the Canadian markets are plenty big enough to have some pretty significant growth before you take on trying to figure out how you win in Taiwan, right? So we're going to play where we know something and where we have some knowledge capital first before we start jumping across any ponds, so to speak. Here's the process that I referenced. I call it the brand incubator process, and this is the secret sauce of the company. I think, Paul, you said earlier today, hey, we like businesses that are simple. This is a real simple business. Travel around the United States and find a passionate entrepreneur that built an incredible brand that's differentiated, but maybe they've got to a point where they've limited their resources or the capability they have to have that brand realize the dream that they thought. We know that entrepreneurs usually are singular in their skills or have limited financial resources. We go and we scour the country to be able to find these amazing nascent brands and these incredible entrepreneurs, which, by the way, often we keep in the company. So the CEO of No BS Skincare and the CEO of True Bar actually are still with us today and still run those companies and run those brands because nobody knows that brand better than the people that invented it. And so we travel around the country and we try to find these incredible, I'd say, differentiated brands that are on trend, well-timed, have growth potential, ideally burn little or no cash, right? Absolutely have to live in this wellness guardrails of where we are today, and we see significant potential for. They're typically direct-to-consumer brands because there's no cost of entry to be able to build brands in a direct-to-consumer environment. And then we take those direct-to-consumer brands and then we move them into this more broader omni-channel environment. So think of job one, acquire those brands. Job two, once we have them, put in the secret consumer products good sauce, right? Around what does the brand stand for? What's the promise of the brand? Where do we think the brand can stretch? What does the portfolio look like for the brand? And ultimately, how do we want to take that brand to market? Which is typically starting with said channels where that brand would at least initially be most successful. For example, the bar category, about 45% of the bar category is sold in the club channel. So if we're going to launch a bar first, we're probably going to start in club first to get that particular brand seeded. And then ultimately, over time, we layer on the other secret sauce, which is just taking that brand and putting it into different categories. Into different channels. And potentially, as I referenced earlier, into different categories. And then if it makes sense, I say divest. I'd say divest potentially or divest opportunistically. At what point does that brand get big enough that we feel the value of that brand is the largest it's going to be? We're at that optimal matrix of where we could still grow it, but maybe it's got the biggest external value. And at that point, we will talk about divesting the brand. So you will see as a shareholder, the portfolio will augment and will change over time. For perspective, we will do, this is the True Bar brand, just looking at a model of where it's worked so far, the proof point of the concept. We took PKANF from a $15 million brand to a $50 million brand. When we bought True Bar, it was a $1 million brand. Last year, $10 million. This year will be $34 million. Probably a little bit on the low end there. And the biggest thing for us is to be able to say, how do we take these brands, put them through the model, and then, as I said, ultimately divest if it makes sense. For perspective, at $34 million, the multiples of what bars typically get bought at, should we decide to sell it, is 4.5 times revenue. So if we just conservatively say 4, True Bar that we own today in the portfolio at $34 million is $140 million market value. Right now, if we were to sell that product externally, I can tell you we're not going to sell it for a while if we sell it, because we think it's got a lot of legs yet for us to have some growth to optimize the ultimate exit, should we choose to do that. But we will look at these brands and potentially divest them if and when it makes sense for us to do so. What's happened, though, and we're not unique in the Canadian small cap market or in the current markets around, even in the U.S. where I happen to reside, what's happened ironically is that even though the results have been positive, we're a relatively unknown company. I'm actually impressed that 3 or 4 of you have actually heard of Simply Better Brands. We've done not a lot of promotion. This is actually only the second investor event that I've been to. We had one in New York City a few months back, and then this one today. We're starting to tell our story. And the reason we haven't told our story yet is that we wanted the story to be good first, right? And when you're $15 million and you're losing money and you're EBITDA negative, it's not really a great story to tell. So we actually have just started to tell the story. And essentially what you'll see is that incredible amount of growth potential in the company, real brands, strong teams. But for you as potential investors or shareholders, certainly our market cap does not today represent what we believe the value of the company. So we're trading right now, as you see, our market cap is about 15 million. I think today it's like roughly 12 million, and the annual revenue 80 million, or roughly 100 Canadian. So we think there's significant opportunity as the company starts to get more aware and get recognized. And candidly, our financial results continue to deliver and improve. We have a reputation of doing what we say we're going to do. We increased our guidance 3 times last year, and we've never missed a guidance. And so transparency is incredibly critical to us as a leadership team. So net, a simple model led by people that have knowledge capital in the space. And there will always be demands for consumers to find products that solve their problems, and that's where our expertise lies. So with that, I think we've got like 2 minutes if anybody had any specific questions.
What do you like to see? Sorry. What are the typical terms when you purchase a brand or a product, and how do you want to see those deals structured?
Sure. Yeah, if you look at most of the acquisitions we've done so far, it's actually one of the reasons we took the company public, is that we want to use the company in our public as acquisition currency, right? So most of the acquisitions have been done with some form of stock and then an earnout, just to make sure that we have an interest in it being successful, and the original founders have a reason for it to be successful as well. Right now, Paul, as you can see, our stock is performing today. We're not buying anything yet, right? Because shareholders, I can imagine the call I'd get from you to say, geez, Kath, your stock's there and you just bought a company and you gave away 40% of the company. I think the comment you had earlier was, to treat stock as gold, not toilet paper. And we have all acquisitions on hold right now until we improve our share price, so that we are prudent to our shareholders and investors, but also that we don't make a mistake in terms of giving away too much of the company when we don't need to, right? And as our cash position continues to improve, certainly cash can be a bigger component of that over time. Yeah, sure. We've got about 72 million outstanding today. Fully diluted, we're at about 96 million. We've got a couple, of course, the leadership team owns typical about 10% of the company. And then we have 2 larger shareholders that own roughly about 20% of the company. Other than that, it's retail and small individual investors. We are followed by one institution, that's Clarus Securities, no surprise. The chairman of Clarus Securities on our board, that we get followed by them. So that's the only analyst or institutional coverage that we have today. Yep.
Carrying off of the gentleman's question over there, what is your acquisition criteria?
Yep.
And what multiple do you typically pay for? Sorry, 3-part question.
Yeah.
And how do you typically structure
Yeah.
those deals? Like how much equity, cash, debt? How does that work?
Yeah. We have very strict criteria. They have to be what we believe to be differentiated brands. They have to burn minimal cash because we don't want to take anything in that's going to use our resources. They have to be strategically in this wellness space of clean ingredients, products, or services. We have to believe there's some synergistic value, right, of bringing them on board, that we find efficiencies as we bring them in. We put them into the machine, so to speak, right? There's a return on that. Multiples, as you can imagine, are very different depending upon the category, right? So if you look at skincare, it's trading about 8 times revenue or purchased about 8 times revenue. Earlier, I mentioned bars are kind of 4, 4.5 if you looked at the last 8 or 10 big bar acquisitions. CBD/nutritional supplements, I think right now you'd be lucky if you got 1 time, right? 1-time revenue based upon kind of the agnosticness of the FDA in the U.S. market. In terms of the offer, it's typically been a lot of it has been primarily stock with some cash component and some earn-out component based upon performance. We didn't have a lot of cash when we went and bought these companies, right? So we had to go through and make sure that stock was a component of the deal.
Maybe add one comment as a board member and also as a guy that has 37 years of consumer goods experience. For people that don't know this sector, large multinationals do not incubate their own brands. They let companies like Simply Better Brands incubate and then they buy, right? So think of like junior miners, right? Mid caps and large caps and buy them once they know it's a proven success. And, you know, Kathy referenced TrueBar, which is an amazing success at 34 million. And we see a path, you know, well north of that, especially with Kathy and the team's experience in terms of landing and expanding distribution, really understanding how to get distribution in the North American market. But if you look at successes just in the bar category, put all the other stuff aside for a second. Kellogg's bought RX Bar for 600 million. Mars bought Kind Bar for multiple billions. Wasn't reported because they're a private company. Mondelez bought Perfect Bar for 280 million. Mondelez bought Cliff Bar for 2.9 billion. So there's that's how the market works in all these categories, but just paying particular attention to the bar category. The same thing on skincare category. L'Oreal doesn't incubate. Revlon doesn't incubate. They go and they buy. They let companies like this incubate. So lots of opportunity with this business model to buy, build, and create huge value over time. So that's essentially the model, and it's a beautiful model. And I know we've got certainly a couple of very bright, shining stars or gems in here that will be of big interest to large consumer goods companies in short order.
Yeah. No, thank you, Richard. I appreciate that. And for perspective, the TrueBar product is outselling most of those bars he mentioned today. So if you went to a Costco, you would see that TrueBar sells more than RX Bar, sells more than Kind, and sells more than Cliff. And trust me, there are people that are watching that I know specifically that we're on Kellogg conference calls right now asking what the heck is TrueBar and where did that come from and why are we losing distribution to TrueBar, right? So it's exciting and an opportunity and personally a little rewarding, obviously, of course. So, but I do appreciate your time. I think we're out of time and I don't want to be rude to the next speaker. I'm here obviously today and tomorrow. Hopefully I'm spending some one-on-one time with some of you and we'll be here tonight, but we're excited about really launching, you know, in many ways, our first awareness campaign of the company. Thank you.